Okay. Here we like to apply our learning of absorption costing and the variable costing to prepare the segmented income statement. So before going for segmented income statement, let's try to understand what we mean by a segment. So this is a common word, the segment. Often we use the term as a product segment, or you use the word customer segment. We use the word business segment in this way. But here we like to define it precisely to avoid the confusion. So the segment can be any part, it can be any activity of my business or of my company, of which a manager wants to know the cost, the revenue, the profit, these financials. So it can be an individual store, or it can be a service center, it can be a customer type, or it can be a sales territory, whatever. So to prepare the income statements individually for the segments, we need two keys. So what are those keys? You can recall that we talked about the contribution format income statement. So we will be using the contribution format income statement because it precisely differentiate between the fixed cost and the variable cost, and it will enable us to make a correct calculation of contribution margin. And again, another significant issue that is we should separate the traceable fixed cost and the common fixed cost. This is a classification of the fixed cost in terms of how the segment is involved in, or how the fixed cost is involved in the segment. We'll talk about it so that it will be clear to you. Okay. So traceable fixed cost includes those fixed costs which can be directly attributable to a particular segment. So how it can be directly attributable? If you think of a segment, and if I assume that that segment is a, say, the company Boeing company, which produces aircraft or which manufactures aircraft, that company has a number of models for the aircraft. So for example, that company, one particular model is Boeing 747. If you go for a flight, you will see that some of the aircraft, the airlines will be using commonly the Boeing 747. So in the Boeing company has set up an building in which they take care the maintenance work of this particular aircraft model. So it is not, this building will not be used for maintaining other aircrafts. So you see that if the Boeing make a segment based on the model of aircraft, this is one particular segment, the segment for based on the models of aircraft Boeing 747. So you see the cost which will be incurred by the Boeing company for this particular building, which has been developed or which is maintained for the Boeing 747 aircraft segment. In that case, the building's maintenance cost will be considered as a traceable fixed cost. So why this traceable fixed cost for the Boeing 747? Because if Boeing decides that I will not manufacture Boeing 747 anymore, in that case, this building will become obsolete. This building will become obsolete. This building will not be required at any reason, and this maintenance cost will become absent. This maintenance cost will become zero immediately. Okay, so that's why you see that this fixed cost can be easily traceable with the manufacturing of the Boeing 747 or the maintenance of the Boeing 747. But you see that Boeing company CEO draws salary every month. So he draws $1 million amount of dollar as a salary. And you know that salary paid to the CEO is a kind of fixed cost. But you see, regardless of the manufacturing of Boeing 747 or other models of Boeing aircrafts, the CEO's salary will have to be borne by the Boeing company. So they cannot avoid the payment of the CEO's salaries, whether they have decided to continue the manufacturing of Boeing 747 or not. So you see that the CEO salaries is not a traceable cost to a particular aircraft segment. So we term this kind of cost payable to the salary payable to the CEO of Boeing company as a common fixed cost. Okay. So we have identified the concept of the traceable fixed cost and the common fixed cost. We'll use this learning more frequently in the next part. Okay. So one thing we like to highlight that based on number of segments we use, traceable fixed cost of a particular segment can become a common fixed cost to another segment. So we like to give an example, like Biman Bangladesh Airlines make segment based on their ticket class, say business class, the economy class. Then there is another, there are some other subclass of the economy. So for simplicity, we are thinking of these two classes. Okay. So you can think of this business class, this economic class. This is a kind of segment Biman Bangladesh has made based on their ticket category. Okay. And Biman Bangladesh also has made a classification of their business or make a segmentation in a way in which routes they operate flight. So let's think of a flight which is from Dhaka, Dhaka to Manchester. Okay, so it's operate directly from Dhaka to Manchester and Manchester to Dhaka. So for operation of the flight in this route, the Dhaka airport charges fees from the Biman Bangladesh Airlines, and also the the Manchester Airport Authority also charges the landing fee from the Biman Bangladesh Airlines. So that landing fee is a kind of fixed cost because it will be for a period, 6 months or 1 year, whatever it is, for a specific number of flights that will be operating during this time period. Okay, so you see, apart from this route, Biman Bangladesh has flight from Dhaka to London. Okay, again, it's not London, it's probably Heathrow. The airport in London is Heathrow Airport. I don't know the acronym properly. So Biman Bangladesh has route in some other routes. It can be Dhaka to Dubai, whatever it is. Okay, it's probably DVX something. Okay, so what I'm saying that this route, all these routes are segments, different segments. But you see the landing fee, what I mentioned, is paid to the Dhaka airport and the Manchester airport for operating flight in this route is a traceable fixed cost for the Dhaka Manchester route segment. But you see, within this route, in their flights include this segment, business and the economy class. So you see, their landing fee, which is paid here in this segment, which is a traceable fixed cost, has become a common fixed cost here for this segment. Why? Regardless of the classes, ticket classes, business or the economy, they have to make up this cost, the landing fee cost. So which is a traceable here for this particular segment But here, when we are making segment in a different way, this cost, the same cost, will become considered as a common fixed cost in this segment. Okay. So one caveat is that sometimes a traceable fixed cost for a one segment can become a common fixed cost in another segment. Okay. So we want to know the segment margin for knowing the profitability or for knowing the performance of a segment. And you can relate it with the contribution margin. I will show you that how it is related. So segment margin can be computed by subtracting the traceable fixed cost for a particular segment, subtracting this from where? From the contribution margin of a particular segment. So if you see that traceable fixed cost, after subtracting traceable fixed cost from the contribution margin of a particular segment, it is a good number. In that case, you will get a good sense that that segment has a long-term profitability, and the vice versa is true. Okay. So one caveat is that sometimes managers have a tendency to allocate the common cost to a particular segment. So we, from the nature of the common fixed cost, we have understood that the common fixed cost cannot be allocated to the segment. For the segment analysis or the financial analysis of a segment, only the traceable cost can be allocated to the segments. So you might ask where we will charge the common fixed cost. The answer is that, say, Boeing is a company. Okay, not Boeing. So think of Biman Bangladesh Airlines. They have a segment like, I'm thinking of the economic class and the business class in this way. I'm not inviting complexity. So the traceable fixed cost should be charged here, okay, in the segments analysis, okay. But there will be some common cost, say in a flight, regardless of the economy and the business, there will be a common fixed cost, like the payment to the pilot, okay. So you see, regardless of the economy class, business class, you have to pay to the pilot. So pilot is same for the economy class segment and the business class segment. So the payment of pilot, it will be counted in the company-wide financials, which is a company-wide financials. Okay. So I will show, or we'll see together that how it actually works. Okay. But one caveat is that do not allocate common cost to the segment. Fine. Okay. So we like to see we like to ask a question in this point. Okay. Say, for example, after making the contribution format income statement, say you have found that a particular segment is yielding negative net operating income. So what will be your decision? Let me give you the context. Say, for example, Grameenphone has made segment in terms of how they generate revenue. Say they sell data, they sell voice call, they sell SIMs, they sell handset. So these are the segments they might make, they will be making for looking at how their revenues are coming. Okay, so what I'm trying to say, for example, from the data segment and from the voice call segment, they are making positive net operating income, and from the SIMs, they are making negative net operating income, and from the handset segment, they are generating negative net operating income. Now, the question to you, what will be their decision when they see that they incur negative net operating income in the SIM segment and the handset segment? What will be their decision? should they continue operating this segment, or they should stop operating of this segment? I believe the question is now more clear to you. So write your response in the chat box very quick. Stop the segment. Any other response? Analytical, continue to the point, contribution margin are positive. Okay, then they should consider whether the negative income generating segment have any impact on the profit of positive income generating segment. 27714, a big thanks to you because you have understood the business very well. So you see that it is not a straightforward decision. Say a segment is generating negative net operating income, then you have decided to stop that segment. In that case, it might have a harmful impact on the well-performing segment. Okay, you see the voice call data are the selling of this are heavily dependent on the selling of SIM and on the selling of handset. It might be less dependent on the selling of handset, but you cannot avoid selling SIM. You might think of Grameenphone has introduced selling eSIM. In that case, you do not need to buy hard SIM or physical SIM. That will be an electronic SIM. But apart from the manufacturing cost of the SIM, they have to incur a significant amount of VAT, supplementary duty with the SIMs they sell. So it might appear that selling SIM is not profitable segment. In that case, if they stop selling SIM, it will have a clear negative impact on their other segments. Okay, so it is not a straightforward. If they are independent, in that case, it is a straightforward. But if they have an interdependency, you will find it complicated. Okay, you have to think more analytically that how can we turn around this segment, which because it has a interdependency with other segments. Okay, so let's try to apply the learning so far in this example, where we like to see that how can we prepare the segmented income statement. Okay, so the company Weaver Incorporation has two divisions. You might think of a Samsung also, because Samsung produces a very large amount of display device monitor and also the television. But whatever, we are thinking of the Weaver Incorporation has a two segment. Here the computer division and the television division. Okay, so we like to see their income statement. First of all, the television segment income statement. So you see contribution format income statement. So first of all, let's try to identify what we already know, the cost of goods sold. So cost of goods sold, from the name implies, it includes what? It includes only the variable manufacturing cost. Only the variable manufacturing cost, because we have identified that it should be variable cost of goods sold portion. Okay, then we like to see that there are other expenses, but we know that other expenses might include some variable portion, some fixed portion, but we see that they have been allocated in different places. So before the contribution margin calculation, we allocate all variable expenses, and after the contribution margin, we charges fixed. Okay, this is not new. We know that contribution format follows this structure, right? Okay. Next, we like to see that how we measure the contribution margin. Again, it is a kind of review. So we make the contribution margin, or we estimate the contribution margin by subtracting the total variable expenses from the sales revenue, right? Okay. Now the question is, note that this is a segment, okay, television segment. So the question is how you come up with a segment margin. So the answer is, from the contribution margin of a segment, you have to subtract only the traceable fixed expenses for the segment. Traceable fixed expenses for the segment. Note that we are not including any common fixed expenses here. Okay, so only the traceable fixed expenses. So what does it mean? This 90,000 expenses will be required if our television segment exists. This 90,000 will become zero if my television segment does not exist. Okay, so that's why we have just subtracted the traceable fixed cost. Now you see the 60,000. This 60,000 is not a company-wide margin or Weber Incorporation total margin. Rather, it is the Weber Incorporation television segment margin. Okay, so you might think of this 60,000 is the contribution the television segment of the Weber Incorporation is making to the total profit of the Weber Incorporation. Okay. Next, we like to see the total picture. So we already have talked about the television segment. Similar case will be applicable for computer segment. Okay. Now the question is, you see that in the segmented financial statements or income statement, we have not charged any common fixed expenses, but you have to recognize that still there is some common fixed expenses, but we'll talk about it very shortly. But you see that how company-wide income statement has been prepared. It is nothing new. It is simply the summation of these two, television and the computer. Okay. So 300,000 plus 200,000, it is the total revenue of the company, Weber Incorporation. Again, if you think of a traceable fixed cost, this 80,000, 90,000 in total 170,000 is a total traceable fixed cost within the in the company. But now the question is, what will happen to the common fixed cost? Weber Incorporation has a let me identify what might be the component in the common fixed expenses. So think of the salary of a Weber Incorporation, the salary paid to the employees of Weber Incorporation for who are working for the company, the common employees who work for company across the segment. In that case, their salary will be part of the common expenses. So one classic example is CEO salaries, top management salaries. So these expenses will be charged here. I mean, the company-wide income statement. So you see that amount is 25,000. So what you see that this common cost has not been allocated to the television segment or the computer segment. Rather, it has been allocated to the company segment. Okay. So you already have understood. We see why we have allocated here these common expenses. Again, if you do not have the television segment, say for example, if you do not have the computer segment, but the Weber Incorporation is running, this company is running, in that case, you still have to incur this common fixed cost. Okay, so understand the distinction between the traceable fixed cost and the common fixed cost very clearly. Okay, now what we like to see in the next part, we like to make a further segmentation of the television segment. Okay, so what we mentioned earlier in the very beginning, that traceable fixed cost, which is for television segment, can become the common fixed cost if we make a further segmentation of the television segment. Say, for example, in a television segment, you might create further segmentation in a way the big screen or the Android TV or the smart TV in this way. But what we are doing here, we are making a further segment in this way, the regular TV and the big screen TV, very simplistic segment of which line, which product, which segment, television product. Okay. Now you see, in this segment, what we see in the regular segment and in the big screen segment, we see the calculation approach is similar. So we are not talking about how this have been calculated, but we are talking about some line items. Okay. So you see that this regular segment and the big screen segment of the television division, it incurs this, it gives us this amount of margin, the regular segment, and the big screen is giving us how much margin? 10,000. Okay. So we see that big screen is performing less compared to the regular television. Okay. Now we like to see there is a this is a traceable fixed cost for the regular TV, and this is a traceable fixed cost for the big screen TV. But what can we do? We can see that the traceable fixed cost for the regular and the for big screen, in total, it is 80,000. It is 80,000. But can you recall that what was the traceable fixed cost for the entire television segment? It was 90,000. So you see, we have been able to allocate 45,000 and the 35,000 fixed cost as a traceable fixed cost for the regular TV and the big screen TV. But what happened to another 10,000 fixed cost? What happened to this 10,000 fixed cost out of the 90,000? What do you think? Where it is? So that is now the common expenses. Common expenses for the television segment. Okay, thanks. So this 10,000 is the common expenses for 10,000. So we see that this in this way 90,000 can be allocated or can be observed. Okay. So now we like to illustrate that how it is possible to make decision from this kind of results of the segments. Okay. So we like to see some scenarios. Say, for example, the company has decided that the television division will make a additional advertising of $5,000. So what do you expect when you make a additional advertising? What do you expect? Immediately. For what expectation you are making additional advertisement? High sales. Okay. So the immediate impact you expect in the sales. Okay. So what happened? It happens that the regular TV sales has increased, and the big screen TV sales has also increased. Okay. So they have reported that this increase is around 5%. So 5% from what? 5% from the previous scenario. So keeping the variable expenses ratio as before, same as before. If we look at the final product line margin, we see the product line margin for the segment margin of the regular TV has become 65,250, and the biggest screen is 12,250. But we see that in terms of the number compared to the base scenario, the margin for regular TV increased by 5,250, but for the big screen TV, it has increased by half of the regular TV, or less than half. You see that that number is 2,250. So overall, when we see that what happened to the television division, we see that overall television division has been able to increase the margin by 2,050. 2,500 overall. It was 60,000 in the base case, but now it is 2,500. So in this way, how the segmented financial statements help us to see that how this kind of spending or how this kind of case will help us to look at the individual segments contribution separately. Okay. Now we like to use our learning for the purpose to see that how it is possible to determine the break-even volume or break-even point for the segments or for the company-wide, or here you like to see, for example, you like to think of the break-even for the television division as a whole. You like to think of or determine the break-even point for the regular TV, and you like to determine the break-even point for the big screen. Okay. Now, if you can recall what we have done in the break-even analysis, it will be very much clear that which cost will be the numerator and which will be the denominator. Okay. So you see that the base case again, the company-wide income statement and the segment-wide income statement of the Weber Incorporation. Okay. Now, firstly, we like to see how can we get the break-even for the television and how can we get the break-even for the computer. Okay. Now, then we'll also see that how can we get the break-even point for the company. Okay. First of all, let's look at the company, then we'll see the television and the computer segment step by step. Now, if I ask you to get the break-even point for the Weber Incorporation, which cost will be part of the fixed cost? Remember, we are thinking of the break-even point of the company, not the individual segment television and the computer. Should the fixed cost include only the common expenses, or it should also include the traceable fixed cost? Yeah, the total fixed cost, some have also mentioned it should be the summation of these two, 170,000 and the 25,000. So it is how much? This one, 170,000 plus 25,000. Remember, we are determining the break-even point for the Weber Incorporation, not the television and the computer segment. Okay, we are summing up the traceable fixed cost and the common fixed cost. Now you can recall that if we want to get the break-even point in terms of dollar, we divide this number by the contribution margin ratio. Contribution margin ratio. Okay, not the contribution margin. So what is the contribution margin ratio? How can we calculate it? So if we have the contribution margin here, 270,000, we have the sales number here. If we divide the contribution margin by the sales, we get the contribution margin ratio. You see, the answer is 0.54. So if we divide the fixed expenses, total fixed expenses of the company by 0.54, the contribution margin ratio, you'll see the break-even sales of the company is how much? It is the 361,111 or 111. Okay, so it is the break-even sales volume for the Weber Incorporation. Now we like to see the break-even point for the television and the computer. So before making a calculation, let me ask you, if I want to calculate the segmented break-even point, which fixed cost should be numerator? Should we include the traceable fixed cost and the common fixed cost together? What your rational thinking says? Traceable fixed cost only. So you have understood it very well. So in the same way, if we take the traceable fixed cost for the television, 90,000, and take the contribution margin ratio of the television segment in this way, 150,000 divide by 300,000, which is 0.5. In the same similar way, we get the break-even point for the television, $180,000, and for the computer, it is $133,330. Okay, the calculation approach is same, so we are not showing this, but you have understood that what should be taken, what should not be taken. Okay, so this 180,000 plus 133,303, this should be equal to what? This should be equal to this one, the company-wide break-even point. Okay. So what you have noticed from this analysis, you have noticed that what we have done, we have not included the common expenses when we are determining the break-even point for the segment. Okay. So there are some issues, or you might think of some mistakes of what managers do when they assign the cost to a segment. They make some mistake. So what kind of mistakes they do? So they make some mistakes in this way, that they ignore some cost. They ignore some cost. So to give you the notion that how it happens, try to understand the value chain first. Okay. Say for example, Grameenphone. Grameenphone creates some value for customers, some value of some values. So you can think of the service as a value they generate for the customers. So do you think Grameenphone has these divisions? So these divisions all together work together, create value for the customer. So all of these divisions or all of these activities are essential to create value. So the value chain is the collection of all the activities what the company does to create some value. So it includes the R&D, it includes the product design, it includes the manufacturing, it includes marketing, it includes distribution, it includes customer service, it includes many things which has not been listed here. Okay. So we have understood that the concept of value chain. So what kind of mistake managers do? So when managers make costing of the segment, what they do, they often ignore some cost which are part of the segment cost, or which are part of the product cost, which are part of the cost. Okay, so they do not include this cost into the product cost. Okay, so you can recall that product cost includes what? Product cost includes the manufacturing cost of the product, and in the absorption costing, it is very purely what they do, that they include only the manufacturing cost. And when the companies religiously follow the absorption costing, they go for looking at the manufacturing cost more clearly. They forget the other cost which have been incurred by the company for generating that particular segment, say, for example, television. So the same company has made some research and development, common research and development, which have become useful for the television and for the computer together. So when they are omitting some cost, in that case, their analysis will mislead us. Their analysis will the manager's analysis will mislead us. So what are some costs the managers might ignore when they will use the absorption costing, which includes the product cost, which includes only the manufacturing? So we can look at this cost which incur for the presence of these activities in two ways. So one way that we can include this cost, or we can include the cost for these activities as a upstream cost. Upstream because these are essential before launching a product or before manufacturing a product. But after manufacturing a product, you need some costs which are for operating these activities. So these costs are part of the downstream cost. So it is self-explanatory why it is upstream, why and why it is downstream. Okay, but you see the purely upstream cost are R&D, the product design. These are not part of manufacturing cost. These are not part of manufacturing cost, and these are not part of manufacturing cost, but they are part of non-manufacturing cost. Okay, so we cannot ignore it. We cannot ignore this. So when we make a profitability analysis for a particular segment, for television or for computer, we have to consider this. We have to consider the upstream cost. We have to consider the downstream cost when we make a product costing. Okay, so let's think of a company, how Grameenphone is distinctive from other competitors because they made a significant expenses for R&D. They make a huge expenses for understanding their customer. So the cost they incur for this activity should be reflected on the charges they are making from the customer. In that case, the profitability analysis for the segments will be more useful. But if we ignore this cost and we think of the segments manufacturing, or the segments, say, what is the cost for setting up a call? What is the cost for setting up a call? Say it is a 0.10 taka, the manufacturing. But you see, Grameenphone always charges more from the customers. So there are some reasons. So one reason is that they make a huge R&D. They have to generate this revenue. They have to make up this cost by generating revenue from the customers by charging more. So when you do not include this, in that case, your costing will not be appropriate, and again, your sales price will not be appropriate. So we need to include this, or we need to think of this cost when we make the profitability analysis. Okay. Another issue, what people do, someone has made a statement that can we divide the common fixed cost in two segments. So I will come into your issue that will be part of our discussion, that some managers are likely to allocate the common fixed cost into the segment, but it might give you the wrong sense. Okay, so I'll explain it later. So what we like to see here, that sometimes managers use the inappropriate method for allocating cost among the segment. So they allocate cost among the segment. Okay. Obviously that they need to use some methods for allocating cost, but that method should be appropriate. You can recognize that allocation base should have some rationale. Allocation base should have some rationale. We made some discussion that how selection of wrong allocation base will lead us to make a wrong decision. You can recall some discussion from the class. Okay. So say, for example, a particular company which has some branches, say A, B, C, D, or you can think of the ACI Logistics Shopno, they have some outlets. So their outlets incur some fixed rent for the premise in which they make business. Say the outlet A and outlet B are situated in some premium locations, and outlet C and outlet D are located in some locations which are premium. So you might have a tendency that as you are incurring more rents for these premises, you will take some of this premise cost or some rental cost of these outlets to these segments, which are costing less. So this is not a good way, that cost which can be directly attributable to a specific segment or a specific outlet, it cannot be allocated to other segments or other outlets. Okay. So in terms of allocation base or inappropriate allocation base, what might be the problem here? Okay. Say, for example, companies incur selling and administrative expenses. Companies incur some selling and administrative expenses. So companies have a tendency that I will allocate more selling and administrative expenses to that segment which is generating more sales, and I will allocate less selling and administrative expenses to that segment in which sales is low. So do you think that is an appropriate way? Or I should look at that where the salespeople are working, or how many salespeople are working, or how many hours salespeople are spending in different segments. That may be appropriate, but when we are thinking that sales is the allocation base for allocating selling and administrative expenses, the allocation base will not be appropriate. So in some segment with the similar selling and administrative expenses, some they are generating more sales, so that should not be penalized by charging more selling and administrative expenses because they are selling more. Okay, so selling more does not mean always that they are incurring actually more selling and administrative expenses. Okay, so let's talk about the statement what has been made by one of us, that is it possible that we make allocation of common cost to the segment. So first of all, you need to know you should not do this. You should not do this because there will be some significant problems if you go for forcefully allocating common fixed cost to the segments which are not traceable fixed cost. Okay. First of all, if you do this, you will see that a profitable business segment might appear that it has become unprofitable. I will show you a case that how it happens. Okay. By checking a quiz. And another issue that if we do this, allocating common cost into the segment, you will see that you are making the managers of a particular segment responsible for some fixed cost in which they have no control. Say, for example, think of Boeing CEO. Now, if you allocate the salaries of CEO into the segments they have made for aircraft, it will be a mistake because the managers of a particular aircraft segment, a particular aircraft model segment, does not have any control on how they manage the CEO's salaries or CEO's expenses. Boeing, the company, the whole company or the central company has the control on the CEO, right? Okay. Now let's make a quick check so that we can understand what are the issues if we forcefully make allocation of the cost, common cost to the to some segments apart from the traceable fixed cost. Okay, there is no issue with the traceable fixed cost. Now the question is, if we allocate the common fixed cost to the segments, what will happen? Okay, so first of all, you see that this is a company-wide income statement, and there are two segments, bar and restaurant. And the foreign restaurant has commonly, they have a bar segment and they have a restaurant segment where the foods are available, and there is a bar segment. Okay, we also have some restaurant in our country which offers bar and restaurant together. They have these two segments. Okay, Lakeshore, Hoagland's Lakeshore Hotel. So this company has prepared this income statement. Now we like to see this question: how much of the common fixed expenses of 200,000 can be avoided by eliminating the bar? You see that they have a common fixed cost, 200,000. I'll ask you the question, you will give the responses very quick. If we stop the bar, the question is, how much of the common expenses of 200,000 we can avoid? What will be your answer? Very quick, please. Thank you. The answer is none of it. And you know the reason. You understand that it cannot be. Now, suppose the square feet is used as a basis for allocating the common fixed expenses of 200,000 square feet. The square feet in which the bar is doing business and the square feet in which the restaurant is doing business. Okay. For allocating what? Note that for allocating common fixed expense of 200,000, we are making a forceful allocation of the common fixed expenses. How much would be allocated to the bar if the bar occupies 1,000 square feet and the restaurant occupies 9,000 square feet. Okay, so this is very simple. How much? How much of the common expenses should we allocate to the bar? The answer is A, or 1/10 of the total common expenses. Yeah, it is very straightforward calculation. 20,000. Yeah. Now, if Hoaglands allocates its common fixed expenses to the bar and the restaurant, what will be the reported profit of each segment? So this is given to you. You see, the bar, which was profitable in the previous case or in the base case, you see it was profitable 14,000. They are making segment margin. But now when you have allocated the common fixed expenses to the bar and the restaurant, what happens? Bar has become unprofitable. Bar has become unprofitable. So what you'll be deciding? You'll be deciding to stop the bar, right? Assuming that restaurant commerce or restaurant guests do not need the bar, but the very straightforward question that you will not be operating the bar if you see that the bar is yielding negative profit to you or the yielding loss to you, right? Okay. So remember that it is not a straightforward, but what I'm telling here that you will be likely to decide in this way. Okay, but we like to see that why the problem is arising here. Note that we have allocating some common expenses to the segments. Okay, you see, if we eliminate the bar, if we stop the bar, why you have stopped the bar? Because you have thought that bar is a loss-making business. Now, what do you expect if you stop bar? What do you expect? Higher net operating profit or lower net operating profit from this scenario? What do you expect? If you stop a loss-making business, what is your expectation? Higher net operating profit, right? Yeah, very straightforward response. But what you see, your answer will be yes, that the bar should be eliminated. But you see, in the earlier case, the net operating profit was how much? 44,000. After stopping the bar, what is happening? Our profit has become higher or lower? Our profit has become lower. So now what will be your decision? Should you continue your bar or you should stop it? You should not stop it, because even after stopping the bar, your profit has dropped from 44,000 to 30,000. So what happens here? If you do something illogically, allocating common cost to the segments forcefully, it will give you a wrong decision. So you have understood. One who asked me that is it possible to allocate the common fixed cost to the segments? Okay, so the consequence will be like this. You will make a wrong decision in this way. So the final part of our discussion is that the financial statements regulators or financial statements regulator wants the company to follow the US GAAP and the IFRS. This will be some recap from your financial accounting course that they require US GAAP and the IFRS require the absorption costing for the external reports. You can recognize the matching principle. Again, some asked me that absorption costing is more consistent with the accounting standards because of this. Okay, so that's why they prefer the absorption costing rather than the variable costing, and it is it is a regulatory requirement to use the absorption costing to comply with the accounting standards. Okay, but you see what will happen. What companies do? Companies are doing the absorption costing for the external reporting required by the regulator, required by the accounting standard. So if we go for using the variable costing for my internal reporting, should I incur more cost? Because my reporting approaches are different for external and internal. The answer is yes, I'll incur additional cost. So will you be likely to incur additional cost? You'll not be likely to incur additional cost. You like to avoid the additional cost. So in that case, which is more likely company will be using for internal reporting purpose? If this is the case, they'll be more likely to use the absorption costing or the variable costing. If this is the case, what we just have explained. What they'll be using, absorption costing or the variable costing? They like to avoid cost, and regulators require that they use the absorption costing for external reporting. Yeah, absorption costing, they'll require it, right? Okay. Now, the advocates of absorption costing are saying the matching principle. Matching principle, we like the matching principle, we love the matching principle. So you need to follow the absorption costing. Whatever the advantages of the variable costing, forget it. Who are saying? The advocates of the absorption costing, but the variable costing advocates are saying that fixed manufacturing cost are the capacity cost. Fixed manufacturing cost are capacity cost, and even if nothing is produced, you will have to incur the fixed manufacturing cost. So it is very essential that you think very clearly the separation between the variable cost and the fixed cost, and you reflect this in your reporting. Okay. So what we are wanting to see, as the US GAAP and the IFRS are requiring the companies to include the segmented financial data in their annual reports. Okay. So what I'm saying, try to understand. In the financial statements, when you explore, you will see that companies report their segments individually in the financial statements. There are some other additional requirement that if the segment fills this criteria, or if the segment has this percentage of revenue contribution in together. Okay. So for example, Renata. A Renata company has a pharmaceutical division. That company has a division for, I would say, for selling medicines for, what should I say, animals, for animals. And they have another segment. Probably for the poultry. Okay. So they report the financials of these three separately, the segments. Okay. So as the companies are requiring the reporting of their segments, and companies are supposed to use the absorption costing by the regulation. So what they want to do, they want to avoid the contribution approach for internal reporting purpose. They have a motivation. This requirement, which requirement? They have a requirement that they will provide the segmented results to the shareholders, and you can provide the segmented results to the shareholders, but again, another requirement, try to understand, you have to use the same method. you cannot do this. For internal segment, you are using variable costing. For external, for internal reporting, you are using variable costing. For external reporting, you are using absorption costing. You cannot do this by regulation. So by regulation, you can follow, you need to follow the same method. Try to understand. If you have the absorption costing reporting and the variable costing reporting in the absorption costing approach and the reporting in the variable costing approach, which one is more, I would say, which one is more, or which one is better representative of the company financials, variable costing or the absorption costing? If you can recognize the advantages we discussed in the previous class of the variable costing, which one is more representatives of the true financials of the company? The variable costing approach or the absorption costing approach? So you can clearly identify the variable costing, variable cost, and the fixed cost very clearly from the contribution format income statement, and if you follow the variable costing, right? Okay. Now you see, if you follow this for internal reporting, and again, you are using the same method for the external reporting, what will happen? Your sensitive data will become immediately available to the competitors. Here, the public includes the competitors. Again, what is another issue? You have to they have to provide a reconciliation. They have to provide a reconciliation for making the consolidated financial statements. You can recall the consolidated financial statements from your financial reporting class, right? So you have to make the availability, or you have to provide the financial statement users the way that how the financials will be reconciled if they merge the financials of the segment. Okay, so these are the some issues, regulatory issues, why the companies are more likely to use the absorption costing, and why they do not release the variable their financial statements following the variable costing approach. Okay, so that is all about for this class.